Good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, September the 24th, 2025, recording this as always in the morning. Okay, let's have a quick overview. I just was looking at the gold chart, and it's been obviously a fairly extraordinary sort of run up in gold. And just some of the questions would be why. It looks as though it is taking a little bit of a pause, but it's difficult to say that this could be a short because at this point, all sideways consolidations have led to breakouts. So we have a big sort of consolidation here, breakout, a little bit of a sideways consolidation, breaking out. So at this point, it would be a brave person who shorts it, but maybe looking for a pullback. And what's interesting is to think why this is happening. And it seems to be a lack of trust in fiat currencies. And the reason I say that is because the price we're seeing here is obviously gold versus the US dollar. But if we look at also gold versus the euro, you can also see it's up a lot. And possibly even more to the point, if we actually look at the dollar itself, let's look at the dollar index. Just bring it down here, where the dollar index. You can see that the dollar index itself has actually been in more or less a sort of a sideways range since July. So obviously it came down a lot. It's depreciated 9-10% versus currencies over the last 6 months or so. And really I think what's happening is that global markets and investors are really saying, hey, Western countries or Western developed economies, they're spending too much. There's zero fiscal discipline. You see that in France, you see that in the UK, you're seeing it in the US. Germany is spending more. There's no attempt at all to rein in the debt. And the deficit spendings just seem to be, even in a strong economy, sort of exploding everywhere. And this has the makings potentially, who knows, of some kind of debt crisis at some point. And I think really what's happening, you see that the US dollar here, it's not only the US dollar which is weakening, it's weakening against other fiat currencies. And the point is that the other fiat currencies, it's not that they're sort of better, they're the least dirty shirt. And so a lot of the money is going into gold as a safe haven. And we look, let's say, at the euro. I mean, for sure the euro is appreciating, but it's also relatively in a range against the US dollar. And you see that when you look at the 30-year yield, so the longer term yield. So if you look at the 30-year yield, you can see that essentially, basically this year, the German 30-year yield's gone from 2.3 up to about 3.4. So it's gone up over 110 basis points. You see that if we look at the US yield, which is here, the 30-year yield, we also see a similar kind of situation there. The US yield is sort of pushing up as well. The Japanese yield, the UK yields, the French yields. So a lot of these developed nations, be it in Europe, even in the US, are pushing up in yields and essentially saying that governments are going to keep on spending. There's going to be deficit spending, and that the way to so the safety valve is just sort of debasement of the various fiat currencies. Not only the US dollar. The US dollar has lost out against the others, but most other currencies also just being debased against. If you look at their 30-year yield. And then, so where's that going? The money is going to safe havens. So, you've got a relatively small market like something like the Swiss franc. And you see the Swiss franc has done very well against the US dollar. But even the Swiss franc, it's so small that, the safe haven money is going elsewhere, maybe a bit into Bitcoin, but certainly into gold. So I think the point here is that gold is, structurally, it maybe has more to go. And if we just look at the December contract here, there's zero sort of negativity here, maybe a small pullback. Similar thing we're seeing today in silver, maybe this pullback. You see that silver here, it's got to that level, it hasn't been at since 2011 of about $44. So there could be, as I say, a little bit of a pause, a little bit of profit taking, a little bit of a pullback here. But basically the precious metals are getting plenty of love, which is not exactly the case. If you look over at the high grade copper, copper is grinding up, but showing a lot less resilience than the precious metals, and that's indicating still some wariness about global growth. And you can see that if anything, this could almost be some kind of sort of a bear flag. It's not a really particularly positive chart, so probably not a great place to be long copper at the moment. Okay, just reviewing what's happened in the last overnight and whatnot in the last 24 hours. We did have Powell yesterday in Rhode Island. Gave quite an interesting Well, the speech was fairly more or less a reprint of what he said in at the FOMC meeting. But in the Q&A session afterwards, he did give a little bit more detail, which was interesting. And essentially, I would characterize it as being relatively cautious. He's definitely saying there are two-sided risks. There's an upside risk to inflation. There's a downside risk to the labor market, which of course is led to mandates. But he did, he was very, very careful to say that inflation was still a risk and that there was no obvious reason to think that either inflation will explode or was there an obvious reason to think that the employment market would collapse. And therefore, again, giving this idea that he was not on a preset course and that he was data dependent. And that's all well and good. That's been his message for the last, 6 or 8 months or so. But what is interesting is that we do have the dot plot, the Fed members themselves signaling another two cuts this year. So it's interesting, as recently as last Wednesday, of course, and we know that that's a bit skewed by the internal mathematics of the committee. We have Stephen Miran saying that they should cut 5 times, et cetera, et cetera. But the point is that Powell himself yesterday, I think, was a little bit more cautious, perhaps even as conservative, even a bit more hawkish compared to the dot plot. Compared to the dot plot is the point I'm trying to say as a reference point. So that's interesting. The other thing as well, which got the market's attention, it got my attention, was for the first time he did come out with a comment, an explicit comment about valuations. He was asked by the interviewer what he thought about asset price valuations, and he said that the Fed it's not our role to sort of comment on asset price valuations, but then he spontaneously volunteered the information that he thought that the stock market was perhaps fairly highly valued, and not fairly as in the sense of it was correct pricing, but as in rather highly valued. A little bit of exuberance there, a little bit of a bubble perhaps, and of course that brings back the famous words of the old Fed chairman from the 90s, Alan Greenspan, who talked about irrational exuberance. Now, of course, we all know that with irrational exuberance, that market kept on going for a long time. So I'm not suggesting that Powell's comments are going to prick the bubble of any, if you think it's a bubble or anything like that. But just to say, it is interesting that it's the first time in my memory that Powell recently has talked about the stock market as being overvalued in some sense. Interesting. So let's just keep an eye on that. Maybe it's one of the little cracks in the market. On the other hand, yesterday we did get another member of the FOMC, a dove, Michelle Bowman. She was much more dovish than Powell, and essentially highlighted the fact that she was concerned about the downside risks to the labor market, and that rather than just doing one preventative cut, which they did last week, of course, that she argues in favor of a bit more aggressive cutting, at least one, maybe two this year, just to really shore up the labor market. So there is definitely a range of viewpoints. Today we have Mary Daly, but it's clear that within the Fed there are now a range of viewpoints going from the super dovish to the merely dovish to the sort of more prudent, data dependent, and even a couple of hawks who are generally still concerned about inflation as a major problem, the major problem, and Beth Hammack would be one of them. So we're really starting to get some internal diversification within the thinking at the Fed. So in just another news, yesterday we did get the data. We got the PMIs. So PMIs in the US yesterday were fairly solid. If I can just bring those up, I'll just bring up today's date, yesterday's date, which was the 23rd. So let's just put that in there and have a refresh. So you see here that Philly Fed was a little bit on the weak side, but if you look at the S&P Global, look at the manufacturing PMIs, they were all over 50. So you could argue that some were fractionally more or less than last time. But the thing is fairly solid. So it seems really that in the US, the problem is potentially the labor market. The actual economic, sort of the engine of the economy seems to be going relatively well. And if you look here at services and manufacturing, a reading above 50 does indicate still expansionary territory from the respondents who answer these questions. So that's relatively positive. In terms of data today, we don't really have a huge amount, as you can see, nothing much really coming up. The more interesting stuff starting to come in tomorrow and Friday. So at this point, there's not a huge amount for the markets to be looking at. Other data which we did get just sort of have a look at the Bund here and just see how the Bund's going. We got the IFO sort of from Germany overnight, and the IFO is of course the survey of current conditions and expectations, and that actually came in quite weak, or at least weaker than expected. And so that but on the other hand, you could say though that the PMIs from Germany yesterday were reasonable. The manufacturing was weak yesterday, but the services was strong or strong. strongish. And so there's a bit of a mixed picture, I think is probably the best way of looking at in Germany. And if you look at the stocks, if you look at German stocks, the DAX, you can see, it is starting to round out at the top, a bit of a rounding top here, just topping out a little bit, but still relatively strong, although is it losing energy. If we look at the broader Euro stocks, we can see they're a little bit stronger. So, a little bit of negative sentiment there in the DAX. And if we look at the Bund, let's just look at the reaction of the Bund over the last, let's say, 12 hours or so. You can see the Bund not particularly ripping on that news. The Bund still trading a little bit heavy, although getting back to sort of a fib levels here. So Germany is sort of presenting a bit of a mixed picture. Just while we're talking about Europe, a fairly at this point, I'm not going to say bizarre or extraordinary, but let's just say a turnaround yesterday, a volte-face from Trump. He met Zelensky on the sidelines of the UN sort of presentations, and essentially said that not only could Ukraine win the war, but they may, regain all of their territory. And he did a throwaway line of saying, and maybe even gain a little bit more. I mean, I don't know what Trump was trying to say there, or suggest that Ukraine should invade Russia. He also said that absolutely, if Russian aircraft violated the airspace of NATO, the Russian aircraft should be shot down. So fairly sort of hawkish and bellicose towards Russia. I mean, it remains to see if and when there may be some kind of Russian reaction to that, even just a verbal reaction. But Trump at this point playing fast and loose with his diplomatic comments, or his comments on diplomacy, which I think is, well, we know what Trump is like, but even for Trump's standards, that's a little bit odd. So that's just something to keep in mind there, but no particular reaction. If we look at something like Euro CHF, the Swiss franc, which we'll just bring up here. So let's just find Euro Swiss franc. So if you look at Euro Swiss franc, you can see it's not a huge reaction. It's not as though the euro sold off against the Swiss franc or so. But it suddenly seems as though Trump, suddenly is pro Zelensky, pro Ukraine. They were going to keep on arming Ukraine until, the end of the war or some kind of cessation of hostilities. So God knows what is in that man's mind, at least in terms of sort of geopolitics and whatnot. But as I say, no huge reaction at the moment. Although the oil market, probably is looking at all this and thinking, because we have increased military activity in Gaza by the Israelis over the last 24 hours. Looks as though there's a full scale invasion trying to capture Gaza city itself. And then if Trump continues to sort of rattle the sword with the Russians, and essentially yesterday he was fairly insulting or negative about Putin, which I'm sure Putin won't appreciate. Just to say that oil here, as you see, is just trading within a range, but I think there's probably reasonable to say there is some little risk premium which is in there, just geopolitical risk, because there's still some potential tinderboxes around the world. And just while we're talking about oil, we had last night the API inventory numbers. So that's the private survey from the American Petroleum Institute. The numbers are a little bit more supportive than expected. So in crude oil, we got a drawdown of almost 4 million barrels. We got minus 3.8 million barrels. So that's quite supportive for the market. We'll see if those numbers are confirmed this morning with the official DOE numbers, the Department of Energy numbers from the US. Also last night at API, the gasoline was plus 1.5 million. So not so good on gasoline. But you see that oil overall just trading happily within this range here of about 61.5, probably up to about $65, just waiting for either something to happen geopolitically or clear news about the direction of travel for the global economy, and maybe inventories. So that's it. So that's about it for today, guys. Let's just keep an eye on Mary Daly, what she has to say. As I say, I don't think we're going to have a hugely volatile day unless Trump comes out with something. Personally, I'll be looking at the oil inventory numbers mid-morning and listening to Daly, and just keeping an eye also on the auctions. We had a relatively kind of reasonable auction yesterday for the 2 year. So there's still support for the 2 year. Today we have the 5 year auction. So let's have a look at the 5 year. You can see that that's come off a little bit since the FOMC meeting here. So let's just see what the market's appetite here is for the 5 year bond, which happens at 1 p.m. Okay, I'll leave it there. Have a great trading day, and we'll continue this tomorrow. Thank you.